Hey everybody, Carlos Diaz here from Forward Side Effects Trading Mission and Omega Plus Trading LLC. Welcome back. Alright, so I'm gonna create this quick video. I got a couple of people asking the fact about price action structure, what we're gonna be covering into the Inner Circle webinar. And for me, the only way for me to explain things is to show you live action opportunities into the market. If we find the opportunity to do so, we're going to try to do so. And on the other hand, I'm going to show you how using simple strategy, but most importantly understanding the price action structure to use other tools on our benefit is what's going to separate you to become a really good trader or not. Alright, so today I'm going to be showing you a simple Fibonacci strategy using the golden mean of 61.8. We're going to talk about that tomorrow as well. It's the simplest one, is what it's like the most widely known and used worldwide. Unfortunately, it's also the levels that most of the money managers and market makers try to go for to take the stops. So if that's the case, why is it so powerful? How can we use it on our benefit? On this video, I'm going to try to show you that. The other question would be, what can I read? What can I hone my time in and try to learn a little bit into the markets? Quite honestly, I don't know. I've been out there for a long time and I read a lot of stuff. There's one, I got a couple of books right here I'm going to show you right now. And this is a really good book. It's not being out there. I don't know if you can see it or not, but is the float analysis. You can see it right here. Powerful technical indicators using price and volume. Really powerful stuff. So the reason that we want to focus on price rating and volume is because you're not relying on technical analysis or tools as a whole, right? The idea is to use those indicators as a mean of decision point on your analysis. So you got to be really good at making your analysis, right? In this case, I'm using, it's one of the books that I read about the powerful technical indicators using price and volume combined. So those are really powerful tools to extend your arsenal of reading price action and be able to forecast price movement. I'm going to show you a couple of examples here in this chart in a moment. The most recent one that I'm reading, Inside the House of Money, is about hedge fund managers and their strategies. Really good, powerful stuff. I will suggest you to get your hands, if you're into reading, this is really good. It will give you the insight of the big players and the way that they think, the way that they are actually pulling off their strategy all across the board on different modalities. So it's not only about technical trading or fundamental analysis and whatnot. They have interesting strategies based on macro trading, long-term views, and it's just kind of open up your eyes that day trading is not the only thing out there. But if you treat day trading like the big players, things will start shaping up with you really hard. Here's another one really interested. I think I found this is a rare book on eBay. I don't think it's gonna be difficult for you guys to access it, but if you can, it's a Profit in the Stock Markets, H.M. Gartley. So obviously the Gartley patterns is really powerful. And this is a really in-depth technical book. So I'm really into this stuff, not more of using technical indicators and whatnot. I'm more inclined into knowing the whys of the market behavior. And these are the type of things that I spend most of my time reading. And here's a snapshot, question mark, of my upcoming, this is actually table of content of the Pivot Step System course. It's going to be really awesome. My course that is coming up. I've been shaping it up for quite some time, so I put a question mark because it's coming up soon. And it's based on the way that I use price action to dictate and forecast price movement on its own, no indicators whatsoever. And you use that basic analogy on top of everything, just like for instance what you're going to be learning inside the Inner Circle. Boom. And it's going to be another story. There's a lot of great comments and great testimonials that we're going to be sharing with you eventually. All right, so back into the chart. So here's a chart where we have no idea what the heck is going on, right? So you're probably going to say, okay, here's the sideways market, what we should do, what we should focus on. Well, if you focus on the broad market, this is a sideways market. Eventually, right off the bat, you try to go into the basic strategy from the beginning to end, and I go from right to left. Immediately try to assess where the most recent market activity has happened. You can see here there is a pivot low going at it. There's another one in there, another one, another one, another one, and the market pretty much shuts up every time that they do so. So we already identified to the bottom side where most likely these guys try to go into this channel, right? So the next question would be, all right, if I wanted to, this is a 120-minute chart. Obviously, that's a reason, because I'm a swing trader. I like to show you this in the big time frames. On the other hand, where most likely is going to be the area where these guys have the most trouble after going into the upside to start coming back down, right? So that's another key factor. So what you should do though is identify a couple of things. What are the highs? Where most likely all these highs are intersecting to each other. It would be kind of in this price point. If we go back, it's going to be around the 5460. That's one area. Then we found here kind of a multiple highs in this area. We also see this is kind of a support right in here, support right in there, support right in there, and so on and so forth. So we know for a fact that there is kind of a range within the range right in here, where we can see that the market is having a lot of trouble between the 5401 and 5460. Now I know for a fact then, by just watching this chart alone, if I'm going to scalp the market to the downside, there's a few things that I know. For instance, one of those is the fact that the market move in oscillations, right? Market move up, down, up, down, up, down, or down, up, down, up, down, up. Hence the Elliott wave patterns. Now that we know that, we know for a fact that we have 5460 and the 54 area, right? So I'm going to mark here as an average the 54 area, and then I'm going to mark also the 5460. I know that's an area that most likely every time that they pull back up, most likely they're going to exhaust their point and look for an opportunity to short the market. So even if it's a sideways market, using price action is telling me right off the bat, you know what, dude? Most likely we can just try to go short anywhere from 5401 and 5460. Now you narrow down the whole spectrum of opportunity of where is it that they're going to go short from this point on. Most likely the market, yes, is oscillating to the downside. They made just a brand new low and they retested the lowest low a couple of weeks back. So that means they're pulling back up. Are they going up? Or most likely, where can I just bet and try to short the market on the retest again to the downside? So where is the highest of opportunity for me, or the high probability trade that the market most probably is going to exhaust and start coming down? Check this out. You're going to bring in your infamous Fibonacci retracement. And most likely, this is kind of a double top formation. This is kind of a high. I can use pretty much from that high to this low, and try to address the fact that, you know what, maybe this guys will reach the 5460, 5427. I'm just using the normal 61.8. That's pretty much only the mean of all the Fibonacci. It's the most used one, yet it's pretty much the most powerful one. The idea here for me is to say, all right, if I know that based on price action, the market usually reached 5401 to 5460, is the mean within those ranges? Yes, it is. So basically, I create kind of a zone. So just basics of it. This is not the way 100% how I do it, but this is kind of the basics for you to get started right now and apply it and learn from it. So that means that I can bet that the market is going to probably hit this level up and probably start going down. All right, so most likely, you know what, that's good enough for me. So it's inside the zone, yes. So it's most likely going to reach that level as a 61.8, yes. And from that point on, what we should do, we should expect that the market to come back down. All right, so where do I place my stop if the market hit that 54.27, and where do I place my entry point? So let's just, as a mean of explanation only, I'm going to show you. So let's just assume that we're going to blindly believe in this, and we're going to place our stop pretty much about, I would say, 20 ticks out, 10 ticks above that level. Let's just say 70. I'm going to use that. And that's going to be our expected stop. Not there yet, but that's going to represent the stop. This is the average of the range that we created based on price structure. I show you just kind of an average in there. And within that average, I know that the 61.8 or the mean is right in it. So I know for a fact most likely that 54.27 could be absolutely reached. And once again, I'm going to draw it from the top to the recent low. I'm going to leave it there so you can see that I'm not coming up with this out of thin air. And if the markets start coming back down, where would they go? Well, there's a couple of things that I use, and the most simplest form of information goes into, this is a big range. And this guys, you know, most likely are going to extend the same amount of the range that break through it to the downside. So basically I'm going to measure the width of the range, and as soon as they break below, most likely that's where they're going. Let's do that. So basically I'm going to go really simple. I'm going to take kind of the average. So, you know, I'm going to use the same high right there, and the average lows here are pretty much, I would say, this one right there. So we're talking about 159, right? So I'm pretty sure that if these guys break the low, they might go 159 below. Let's do that. So 159. So a little bit further down. 159. Well, you know, let's just round it out to 160 there. I'm going to mark that as a target. Let's see what happens. So we already know what's going on. So we use price action structure to identify a zone within the zone. Then we identify the potential possibilities for the market to reverse using just the golden mean, right? Very simple, very straightforward. So we're combining price action with the average of the support or resistance in the zone, and using a simple indicator that is available for everybody in any trading platform. But now I'm predicting the market that if they break the average on the low right here, you know what? I'm going to extend this from this low. So where is it? Oh, it's right here. It's in the 51.59. So the other thing that I like to do is, all right, what if that's going to be an exhaustion point completely? I like to go with about 50% of that. All right, so that's part of what we teach on the pivot step formation right there. So let's just say 160 divided by 2. We're talking about 80 ticks. So you know what? Most likely I can take my first target out at 80 ticks, and most likely, and I use other levels that I'm going to use. I'm going to leave for the students anyway. But most likely, I think that was close enough. 180. That's going to be the first target for me. Boom, right there. And I'm just using this on the long-term perspective. And basically, these are the two targets down. This is the golden mean that I'm looking for. I'm going to leave that in there so you can see that I'm not coming up with this out of thin air. And most likely, let's say, the market is start going up. Next level up, I'm going to move this to the forward. Shooting up. Inside the zone, yes. Excuse me. I noted an exhaustion point right there at the 54.18. Coming back down. Starting to come back down. So in order for me to make sure that they are going down, this is the most important low right here, right off the bat. This is important low. It's not until they take this low that the market can continue basically back into the range bound, or take the most important high right there, right? Something like this. So the market can probably hover, and in order for me to go short and still below this level anyways, I'm looking for a short position right there below that level, right? Unless they hit this mean, where I'm going to be looking to short against the mean. All right, so let's see. Boom, that's the key factor. We're going to go short right at there. They just say that we shorted at that point, and you know that our stop is, you know where, right in there. Pure price action. Oh, but the risk reward ratio, come on, don't do that right now. It's not important, the risk reward ratio, because we're going for 54.39 and possibly 51.59, right? Or 60, whatever that was. So most likely, I know for a fact the mean has been touched. That's the protection for our capital. So we're protected. It's just a fact, will this be the key factor for the market to start going down? Possibly. They have done it before in the same range, and right off the bat, if you take a closer look here, they have done it right at the same price level. When I go back in time, that was a price level here that has a lot of trouble with it. That's a price level that the market just went through it to the downside here, and the same price level here that the market tried to test it down. So we got kind of an indicator here that those are price levels that are really important, and I bet you that if I go a little bit back in time, that also happened right in there. So let's see. We showed the mean, and now we're expecting the market to go down. We got two targets based on price structure itself. So the market start going up. Outside bearish bar, that's a totally reversal pattern. So I'll take my stop and move it into swing high right there. Why? Because it's a power outside bearish bar or engulfing bearish bar. So the mean is holding pretty decent, and we're going to go for the 54.40, 52.40. Let's see. There you go. Almost. No, we missed it. That's pretty decent. That's a pretty decent move on the downside, and then we can repeat the exact same process again over and over again. So we can take the exact same thing, move it here, probably go in here. Most likely that retest over there of the 53.72 is an important one, but you know what, maybe it's this one, which already hit right there. So I know for a fact that we got two actions here that I can say they could probably touch that, or maybe this one, right? So I have two potential outcomes here that could happen very strongly. Let's see, continuing for target 1, target 2, and it looks like it was that one, multiple highs. They came back up again. Let's see if they hit this one. They did. Boom. There you go. We knew about it. So pretty much I know that our stop can be trailed now to those levels. And now I am a little bit on profits and swing trading this to the downside. Let's see if I get stopped out or not. And this is where we're at right now. So based on the original point of view, right, that first trade right off the bat, that was the entry right there with a stop of about 50 ticks and a potential entry point, or exit point of 180. I'm not going to complain for the fact that we missed that for about 13 or something. And it looks like these guys are going down. And I know for a fact that right now is a good opportunity to short this market. So this is a simulation account. You can see it right there. I'm gonna short this market. I'm gonna show you something pretty quick. And this is pretty much all I can say and all I can do. I'm still bearish this market. I'm still going down. This is a really nice going reversal pattern that we were expecting into the market. And basically all we have to do is stick through to this situation. Right off the bat, if I'm swing trading this market, I can use the same opportunity right there at the moment because I'm betting that the market is going to come down. Now I can then drop down to a lower time frame, 30 minutes or so, and do the exact same thing on the opposite, right? But on the other hand, I'm going to be a little bit more smart, and I'm going to try to aim here for prior support or resistance that are pretty much clear on the path of our expectancy, right? All right, so basically I'm going to try to find where is the transition point. Here's the transition point. Is in the 82, 83, 85 level, and these are transition in the high. So we're talking about, let's see, 93, 91, and the double bottom formation is right there at the 89. You know what? I'm gonna try to bet market could go all the way to the 90. So I'm gonna put the 90 right there, and I'm gonna try to aim for that 90 level on the way down. Most likely that's what's going to happen based on the transition point, based on price action alone. There's no other indicators that I need in order to calculate this possibility. It's highly probable that's what's going to happen. Now, can I validate that the market indeed did a pullback that I can just pretty much hold into it and continue down? Absolutely. The only thing that I can do is just drop down to a 5-minute chart probably, and I bet you that this pullback might be represented for the most recent part of the potential transition. One key for me, I will be more thorough on the course itself. You see the swing low right there? That's the one that I'm gonna try to aim for. I got a double formation in this area, and out of this information alone, that's the high that I need to take in consideration. Don't ask for just bear with me for a moment here. So all I'm saying is, based on the price structure itself, back into price action, guys, I bet you this is a key important high that I'm talking about. That's an outside bearish bar. That's a really interesting point right there, and I bet you that if I measure from that high to this low, that's a golden mean. Also, I can see that for a fact that it might be a golden mean because that high is similar to this one, and that one, if I go back in time, is also a support right in there. Okay, so I just check that out, bring the Fibonacci tools, I take that high to this low, and long and behold, boom, there you have it. All right, so that is a golden mean right there. So we were able to call this absolutely great in terms of the fact of the information that we got based on price structure. And now we definitely can use a tool like the Fibonacci, so Elliott patterns, whatever you feel comfortable with, to pretty much understand which one of those levels are the ones that has the highest probability of being able to be used. I can take my stop and guess what? Move it down. So now I don't have to risk that much now at that point. The only thing that I have left right now, guys, guess what it is? Waiting for this target to be reached. And as I explained to you earlier, pretty much when you go back inside, that's a transition point in order for us to choose that. This is how we play it every single day. Of course, yes, it's more to it than whatnot, which is we go really thorough and in-depth of more information about profiling the market, understanding what is going on, the precise interest. We're going to be really more explicit tomorrow when we explain on the webinar that I'm going to be showing you tomorrow how to become a good, awesome analyst, and then use that information to, as a byproduct, become a great trader with consistent profit. All right, so what I'm going to do, I'm going to pause the video, I'm going to wait until this moves down or takes us out, and we'll take it from there. All right, guys, we're back, and as you can see, as predicted and forecasted, 52.90 by the tick. We practically were able to use price action structure as we explained it before, using pretty much pure price action, the golden mean, as a way of understanding what the market most likely will reverse. And then we use on the lower time frames another immediate and powerful strategy, which is price action itself, to identify the most probable areas where we know the market most likely will do based on what they have done before in the past. Okay, so price action leaves clues and history clues. History repeats itself basically by leaving and leaving a trail of information that we can use into the future and identify most likely where those levels are going to be reached. We were looking for a potential sell setup at the 53.13. Obviously, we showed it there. We had an initial stop loss around a high area of the 53.82 as the immediate stop loss. Then we trail it down because we knew that was also on the lower time frames of the 5-minute. Remember, that was also kind of another mean area, mean reverse area where the market reversed from it and started going down. And if you remember, we still have in place another target here at the 52.40, which is most likely where they're heading next. So, but for the sake of simplicity of this information, we were able to capitalize on those levels. That was the area of the entry. That was the immediate target that I had in place based on the assumption of the information. And that provided around a 20+ point right in front of you, so you can understand you can do this. If you give me the opportunity to teach it to you and you're sick and tired of wasting time by guesstimating into the market, in the next upcoming webinar, whenever you're seeing this video, you're going to have the opportunity to watch me explain from beginning to end, and at the same time have the opportunity to learn how to join us and become an incredible analyst and excel in your trading. Up until then, and with that being said, I'll see you on the next webinar.